Welcome to CSIS Online. The way we bring you events is changing, but we'll still present live analysis and award-winning digital media from our Dracopolis Ideas Lab, all on your time, live or on demand. This is CSIS Online.
Hello, everyone, and welcome to today's conversation. I'm Nikos Tsafos, Interim Director and Senior Fellow with the Energy Security and Climate Change Program here at the Center for Strategic and International Studies. And I am very excited for today's conversation where we are hosting the International Energy Agency in their latest quarterly gas market analysis. Those who know me know that I've been waiting for the IEA to publish a regular gas report for a long time. There's been an oil market report that's been going out for a long time, and as the gas market has matured and expanded, I've been very interested and excited to see the IEA take up this challenge and produce more regular analysis on what's happening in the gas market. And so this is the product of that work, and it's the second one to come out. So we're so excited to host Jean-Baptiste Dubreuil, who's a senior analyst with the International Energy Agency, to present the findings, and to also be joined by Andrew Walker of Cheniere Energy to offer his perspective on gas markets development. Before I get started, a couple points on logistics. You can use the Q&A function to ask questions. Those will come to me. We will have about 20-25 minutes of opening remarks, then we'll go into a discussion, and I will do my best to weave in those questions into the conversation. But with that, I will get us started, and I will pass the mic to Jean-Baptiste.
Thanks a lot, Nikos. Good morning, ladies and gentlemen. It's a pleasure to be with you today, and thanks a lot for having me and for your very kind introductory remarks, Nikos. Hope they will be up to the challenge. So without further ado, let me try to successfully share my screen for the presentation. Hope that you can see them. So as Nikos said in his introduction words, we have released this very day the second issue of our quarterly gas market report, which covers not only our estimates for 2020, but also the past 3 months, which have been quite lively on the gas markets, with a winter that didn't disappoint analysts when it came to sudden changes and moves in the supply and demand sides. I will not go into all the details of the report. It's available and free downloadable from our website. Just want to share with you a couple of findings across 2020 and our view for 2021. So to begin with, looking a bit back at some lessons from 2020, we had, of course, a very particular market last year on all accounts. I think that among all energies, gas should have been one of the most affected, not only by, of course, the overwhelming impact of the coronavirus crisis, but also on the impact of one of the warmest winters ever recorded, which, as you know, natural gas is particularly sensitive to temperature changes. And we've had all across the Northern Hemisphere very mild temperatures in the first quarter of 2020. In spite of those circumstances, we have seen, and this is something you can hopefully, I hope, can see on the left-hand side of this slide, that natural gas did manage the situation rather well, with, according to our latest estimates, less than 2% year-on-year decline, 1.9 to be very precise, or about 75 billion cubic meters. This remains an important figure. This is roughly the equivalent of the consumption of a country such as Italy for a full year, but and also the largest drop ever recorded. But again, comparing to the importance of the situation, the impact on the economic markets and the energy market large, remains rather resilient, especially if you look at other fossil fuels. See that oil has declined by an estimated 9%, about 4% for coal. Within that global picture, if we consider liquefied natural gas, LNG, as a single commodity, the picture is even more buoyant with some positive growth. Limited growth, although our estimate is that global LNG trade increased by about 1.4% in gross term, 1% net terms, net of reloadings. So that's far from the two-digit growth rates that we have seen in the past. Nonetheless, positive growth. Looking a bit more into the details at the anatomy of last year's decline, if as provided on the other side of this slide, you see globally the most impacted sector was power generation. It really roughly account for half of the impact on the overall gas demand decline. Nevertheless, the situation could have been much worse, with low prices, especially at the middle of the year, providing support to natural gas in power generation, mostly at the expense of coal, the expense of oil in some markets jurisdiction. And as you can see, in the case of North America, power generation didn't even bring a positive contribution to total demand, with an estimated 3% increase in gas consumption for power generation, in spite of negative growth for electricity in the US last year. Other sectors, very briefly, the second most affected sector was residential and commercial, on a combination of warm temperatures in the first months of the year, as I said earlier, for residential, and also, of course, the impact of the lockdowns for commercial activity. Most of the impact was felt in Northern Hemisphere, owing to the temperature effect. Some of it was regained in Europe, one of the most affected being North America, as you can see. And for the third big block of consumption, industry, that was the most resilient among others. First, owing to the positive contribution of the faster growing markets in emerging Asia or the Middle East, also owing to the fact that natural gas consumption in industry is concentrated into a limited number of segments of the industry, which managed to keep activity even during the lockdown. So if you compare it, for instance, with electricity consumption in the industry, the impact was much less visible, especially during the lockdown period. So this is for the demand side, the static picture. If we now look at the dynamic picture of what happened last year, just using the pretext of the prices to illustrate that, it was really a roller coaster year. We started with close to average winter conditions. Of course, steep fall in the first months of the year, first with this very mild winter and unexpected mild winter conditions, followed by the outbreak of the crisis and the lockdowns. Most of the impact on the demand side was felt, of course, in the second quarter of the year. At the end of H1, the total gas consumption impact was about 4% contraction year on year. So at the end of the first half of 2020, the market had reached historically low level of prices on all the major markets, as you can see there, close to or even below $2 per MMBTU equivalent in Europe, in Northeast Asia, and in North America. This owes also to the fact that supply had needed a bit of time to adjust, especially on the LNG side, owing to the logistics of reordering, canceling the cargoes. So there was a bit of a lag on the supply side to adjust for this rather steep and unexpected fall in the demand side. But with the low prices, the easing of the lockdowns at the beginning of the summer, we saw a rapid recovery of demand, which prompted, alongside with a tightening on the supply side, some rebound on the pricing. Before going to the what happened more recently in 2021, just try to illustrate this evolution of supply and the flexibility of supply. This was one of the main lessons and the paramount importance for the balancing of the market in such an unstable, unprecedented drop in demand. The ability of supply to adjust in an orderly manner was a key component to avoid a complete collapse of the markets in the middle of the year last year. One of the good examples is the evolution of flows on the LNG market. You can see on this slide on your left the import side, and on your right the export side. So on the import side, it's clearly a game of transfer flexibility in between Asian and European buyers. You can see the traditional buyers, JKT, Japan, Korea, Taiwan, in the light green bars, and the European buyers on top of them, adjusting one with each other. Europe playing the role of market of last resort when the demand falters in Asia, and vice versa, as we see a rebound in demand in Asia in the last quarters of 2020 and the beginning of 2021. Europe takes less LNG and relies on other sources, either import through the pipelines or storage during the winter. On the supply side, the picture is even more impressive. This is basically, you have three big players, 3+1. Russia is likely to be a player. We currently have three big players. The two big ones in volume, Australia and Qatar, are more or less baseload suppliers. You see that their volumes have not been hugely affected, even though, of course, during Q2, there have been some adjustment. Australia particularly was affected by those adjustments on the Asian market. But it's really the US LNG exports that made the difference in terms of flexibility. And if you look at the difference in between Q1 and Q3 in terms of volumes, this is really striking. Of course, on top of that, Q3, you had the impact of short-term closures during the hurricane season in the Gulf of Mexico, but most of the reduction was owing to that commercial flexibility enabled by the US export contracts. So this takes us to closer to today. What happened during the heating season? We've had a quite interesting and rocky winter season, starting with rather average temperatures throughout the Northern Hemisphere in October. November was milder than expected, so prices remain rather flat, even slightly declining in North America. So the Henry Hub is going slightly below. And then the first cold snaps began in mid-December in Northeast Asia, and were followed by a steep increase in LNG needs in Northeast Asia. I won't go into the details. I think that the situation is familiar to most of you. We had in January a conjunction of factors, a sudden drop in temperatures in Northeast Asia, Chinese consumption increasing on the back of further coal to gas conversions. In Japan, some closure or underperformance of the nuclear fleet, combined with heavy snowfall, which limited the capacity of the solar panels to deliver electricity. And in Korea, additional generation need induced by the limitation on the coal fleet ability to deliver. So those factors combine at a time where the availability of LNG supply, particularly of neighboring LNG suppliers, was limited, with some outages in Indonesia, in Australia, in Malaysia, which led to more recourse to longer distance suppliers, especially from the United States, leading to longer voyage times and some congestion in the Panama Canal. So all of those ingredients provided the spike that you can see on the Asian spot LNG prices, which reached above $30 per MMBTU at the top for JKM, up to $40 per MMBTU on the OTC market. And of course, it was short-lived, but was a first in terms and a record in terms of prices. Even in the winter of 17-18, when the Asian market was suffering from shortages, again owing to severe winter conditions in China and supply shortages, we were not even near those price levels. Second episode is also well known, what happened with the polar vortex in the US and Canada and northern Mexico in February. This was even shorter lived, but also had some repercussions on LNG capacity, with limitations, some short-lived limitation on export capacity in Texas, and limited exports to northern Mexico, which led to spreading the rolling blackouts to the northern Mexico. So the main takeaways, apart from the volatility, the very strong volatility that we have seen, first one, the important role of storage, whether it be underground storage in the case of Southwest US or continental Europe, which acted as a balancing against the tensions on the Asian market in the first spike, or floating storage, LNG storage in the case of Asia. And the second one, the excuse me, the fact that even in a rather depressed market situation, security of supply remains a major point to monitor when it comes to energy and to natural gas in particular. Just to conclude with this very brief overview of our findings, a few words about 2021. So this is the situation as we left it for 2020. If we look now at 2021, our estimates are that globally, 2021 will be the year for recovery in terms of global gas consumption, with about 3%, 3.2% to be precise, in terms of global gas demand growth. As you can see, most of that growth comes from the industry sector, the dark blue bar on the chart. This is the driving force. It comes mainly from the Asia Pacific and North American markets. This is, of course, heavily linked to the prospects of economic recovery. And we have seen a couple of days ago the IMF revising its macroeconomic perspectives upwards. But of course, this remains a particularly high factor for uncertainty, especially for Asia Pacific, as this industrial sector growth relies both on the domestic market, also the prospects of the export markets for the Asian produced goods. Second factor is the recovery in residential and commercial. This is a bit more certain because as we're at the end of the heating season in the Northern Hemisphere, we have seen much of it already happening. Except if we have a very mild end of 2021, most of that is more or less taken for granted. The third factor is the role of power generation. Last year, power generation was one of the enablers of natural gas resilience in the context of the crisis. This year, it's a bit different. It's lagging behind and, in fact, hampering the recovery, simply because with prices recovering to higher levels, the competitiveness of natural gas in the power mix becomes more challenging, especially in the North American markets, where gas becomes caught in between renewables development and the potential comeback of coal, which becomes more competitive. The story is a bit different for Europe. We see a bit more stagnation because the fuel cost competition is the same, but the relatively high level of CO2 prices provides some shelter for gas-fired generation in Europe in the current context. So the two main messages for this recovery: first one, we do expect natural gas demand in 2021 to return to its 2019 levels and beyond that. But this is highly uncertain, of course, driven by the evolution of the global economic recovery. And second, this is not the same pace of recovery for each and every region. Some regions will clearly see some growth, while some others, especially the more mature markets in the Northern Hemisphere, not so likely to see a full return to 2019 numbers for this year. So very quickly to summarize, we've had a very strong recovery at the beginning of this year, which was on the back of colder than expected winter temperatures. We've had some strong support provided by LNG in terms of flexibility in times of need when we were at the lowest point at the middle of last year, and also in terms of tension during this winter, in a context of huge volatility of prices, with historical lows 9 months ago, historical highs a couple of months ago, which highlights the impact security of supply not to be taken for granted, even on those very specific market fundamentals. And for this year, the outlook remains uncertain, with a prospect for recovery, but of course, subject to a long list of caveats. Thanks a lot for your attention.
Well, thank you, Jean-Baptiste. This was excellent. You put a lot on the table, and we will come back to that in the conversation. But let me first turn to Andrew. As Jean-Baptiste explained, U.S. LNG was one of the primary or major adjustment mechanisms for the market in 2020. And we saw 2020 be a real test for the industry on both extremes: very low prices this summer, very high prices in the winter. So I wanted to maybe turn to you to give us a little bit of the perspective of a U.S. LNG exporter. How did you experience 2020? And then thinking also to get some of your reflections on the numbers that Jean-Baptiste put in terms of 2021 and how you're seeing essentially us coming out of that very tough year.
Okay, thank you, Nikos. Great to join you and Jean-Baptiste today. Thank you for inviting me to comment and join the discussion. And I'm going to make three comments, make my structured comments in three parts, really, building on what Jean-Baptiste laid out, and also giving, as you said, the perspective from Cheniere in terms of the unprecedented year that we have been through. And actually, an industry colleague asked me recently, do you think you'd be able to give a talk without using the word unprecedented? I said, well, I could try, but it's probably impossible at the moment. So here's my 3 points for you and folks listening, building on Jean-Baptiste's excellent presentation. Firstly, I think anyone reading the market at the moment, understanding what's happening in the market, you have to remember the context, and that's really the unprecedented bit. I've heard a lot of people express surprise at some of the things that are happening, and you say, yeah, okay, but step back. The market lows of Q2, we were experiencing, as Jean-Baptiste said in his presentation, the largest recorded drop in gas demand ever. It was the largest drop in energy demand, GDP, since World War II. These were kind of once in a century impacts. So don't be surprised that we kind of reached some market lows on the back of that. And then in the winter, I liked the words on your slide, Jean-Baptiste, sporadic cold spells. I mean, my colleagues in Texas who were experiencing single-figure Fahrenheit temperatures with no power, no water, in houses that are built to stay cool in the summer, those were extreme, weather events. So, and Asia was having 1 in 50 winters in China, 1 in 30 in Korea. So not surprising that we kind of tested the upside as well for short periods against those events. So really bear in mind the context when you're reading the market. And to some extent, we shouldn't be surprised at some of what we've seen. Secondly, and again, Jean-Baptiste talked about this, I think a lot of what we're going to discuss comes back to the structural evolution of the market. Now, LNG is not a commodity by general definitions of commodity, but the direction of travel is clear. It's much more flexible, much more liquid, certainly than when I joined the industry, but it's rapidly moving in that direction. And I think the way that the LNG industry dealt with the road bumps of 2020, both the down and the up, is really testament to its growing resilience. Again, as Jean-Baptiste indicated, Europe and the US played major roles in providing that flexibility to the market system. And I think the US exports really have been a game changer in that regard in 3 ways. The US really has changed the game in terms of making LNG much more abundant. I mean, others put in place 40 million tons of incremental supply in the last 2 years. And the latent supply gives buyers out there the potential supply, the latent supply gives them confidence that is a balance that's here to stay. LNG will remain abundant. It's also Cheniere pioneered the destination flexible cargo business model, creating flexibility which begets liquidity. So I think we're seeing a much more liquid industry. And then the third way, and this is what we really saw last year, was turn down on the supply side. We saw US capacity running at utilization factors of about 30% in the middle of the year, which is unprecedented amongst most suppliers that want to run steady state and perhaps give the buyers 5%, 10% turn down. And that is an option that is owned by the buyers. People kind of think of US LNG deciding to turn down. This is not an OPEC type option. This is not the suppliers turning the spigot. This is the buyers having a commercial option. Now, it's not free, I would admit that, but it's another tool in their toolbox in order to manage the market, to manage the imbalances. And I think that contributed in quite a big way to the orderly way that the market came through last year. And I think going back to my first point, given the unprecedented circumstances, you shouldn't assume that is going to be the new normal. If you look at Platts data, there were around about 170 cargoes cancelled from the US last year. They're currently showing a count of 7 through the end of May. So I don't think you should assume that every year is going to be like 2020, unprecedented. And then my third point, and this is really where myself and Jean-Baptiste start to diverge in our perspectives, I would agree, yes, the recovery is uncertain. In fact, I often think of a quote, "The future is unwritten." Joe Strummer, that's probably the first time you've ever had the lead singer from The Clash quoted at the center. In LNG, that is only partially true. And going back to the last time myself and Jean-Baptiste spoke, I remember saying at a conference, there were 3 things I would watch in order to get a sense of where 2021 would turn out. And this was kind of late last year, middle last year. Firstly, supply, and that's the bit that's written. There's a 5-year build time for LNG. We know what's coming online. We know when our trains are coming online. We know when other projects are coming online. We know that supply has been building very rapidly on the back of initially Australia and then predominantly the US. We know that's slowing. The rate of growth on the supply side is set to slow over the next few years, and that will act to tighten the market. At the time, the other 2 dials, I said I couldn't really give any certainty on. One was weather. We are a very seasonal commodity, to use that word, product. And depending on how the winter plays through, depends on how we're set for the year. And actually, in retrospect, I can now forecast that the winter of 2020-21 would be very cold in places and would leave us quite short as we come into this year. The market, I think, got slightly complacent on the two very mild winters that we had in the preceding winters, and possibly made the mistake of assuming that was a new normal and not paying attention to the way that weather can come in and punish you if you don't plan appropriately. And then finally, and this is where I do agree with Jean-Baptiste, the third dial is, of course, recovery from the pandemic, economic and physical in terms of fuel use. I would point out, though, that I'm very much more optimistic, I think, than the IEA in terms of the next few years. I see a strong rebound, a strong growth. To give you some stats, in Q1, we saw Asian LNG imports up 11% year on year. We saw China up 30%. China imported 5 million tons more LNG year on year in Q1 than it did a year earlier. Now, I would admit that we had cold weather in Q1 and it was from a low base a year ago, which was quite mild. But I think the fundamentals, there are also some fundamentals in play there. We've seen Asia recovering pre the cold weather, positive year-on-year growth from September. So part of this is a rebound, part of this is underlying fundamental growth. And I think we're going to see that growth continue. It's interesting, Jean-Baptiste, that as I kind of think back initially, the prognosis for gas was it was going to be down 5%, and then it was 4%, and then it was it's now ended up as less than 2%. I think we've surprised ourselves in terms of the resilience. And I suspect if we looked at the elasticity of demand versus the pandemic, however you kind of measure that, the elasticity has reduced over time as we get more used to kind of dealing with working in this environment, consuming in this environment. And I suspect, as we go through, hopefully not much more of this, we'll find that the impact is actually less, just as we were slightly too negative when we kind of looked out from Q2 last year. And that leads me to be much more positive in terms of near-term growth as we go through 21 and through the next few years.
Thank you, Andrew. Excellent comments. And I particularly appreciate your comment about who drives the adjustment on the US LNG side. And this isn't OPEC. I wrote a piece last year, I think it was called "Who Needs a Gas OPEC?" And I think it was quite a case study of, if you think of the drama that accompanied sort of OPEC around March and February, March, April, and what it took for the oil market to adjust versus the gas market adjustment, which was much quieter, but also not really coordinated. I think it was quite an interesting contrast of how the two markets adjusted to this downturn. Let me pick on a few themes that both of you talked about, and I wanted to maybe start with the question of pricing. I don't want to ask about sort of the specific level of pricing, but more broadly, if you think about the gas industry, we've had a system, especially on internationally traded gas, that has been built on prices that are linked to oil. Over time, different parts of the world have moved away from that. First, North America, then continental Europe, increasingly the spot market in Asia. And we also had a question on this from the audience. When I look at something that goes from 2 to 25 or 35 or even 40, as Jean-Baptiste said, in the over-the-counter market, what does that tell me about these markets from a structural perspective? We've had obviously Cheniere sort of pioneer that Henry Hub cost plus model, experiment even with a netback model where you take the price in Asia and you try to subtract back to the US. Obviously, with the caveat, and I really appreciate you, Andrew, pointing that out, that 2020 is not a year we should try to extrapolate too much from, obviously. But what did we learn about the structure of gas pricing, the future of gas pricing in that really tried market environment. Jean-Baptiste, if I can maybe start on you, and then Andrew, would love to hear your comments as well.
Well, thanks to both. Thanks, Andrew, for your very insightful comments, and thanks, Nikos, for this question, a tricky and interesting question. When it comes to Asian pricing, I guess it's a question of seeing the glass half empty or half full. I guess there has been some major changes over the past years, both in terms of price formation with the development of different price indices. I've quoted the JKM as one of the leading examples, and also substantial changes in terms of domestic market regulation and domestic pricing in major economies, whether it is mature markets or faster growing markets in Asia. This being said, looking from the textbook, we're still far from having a Asian hub, a price that really reflects the supply and demand. So it can be seen as a chicken and egg question. We will have a market once the contracts are adjusted to the market, or vice versa. Is it the fault, or is it the reason of coming from the oil indexation? I don't know. I guess that oil indexation is convenient for some buyers, and whereas other buyers also wanted to have more diverse indices and also want to take some exposure to more fundamental driven sort of pricing. I think that the main difference, so going back to one of the remarks made by Andrew, when it comes to the dynamics of pricing and the dynamics of recovery, it's true that China has been, and will remain one of the big drivers for growth, also for the changes in the dynamics of trading in Asia. But the fundamentals of Chinese gas markets, not sure they can be easily replicated to other markets in Asia. The engines of growth for gas in China are the residential and industrial sectors. The role of gas in power generation is, not to say negligible, but not supposed to become a major piece into the game. Whereas in other markets, it's power generation is a dominant feature, and power generation is competing with coal, either domestic coal or imported coal. So the question and the sensitivity to prices of the buyers is much more important than in China. So all this to say that I think that to solve that conundrum, or at least to continue to advance towards the direction of a Asian market, or eventually an Asian market price, the two components have to further go along. The market component, as Andrew highlighted, the flexibility, the evolution in the commercial terms has made great progress, but we still have a majority of contracts with an oil indexation, particularly in Asia. So this will progressively change as legacy contracts disappear, but for the time being, we still have a large amount of oil index contracts. And on the other hand, domestic reforms, pricing reforms to foster fundamental at the core of the prices, rather than administrative prices or oil index prices on the domestic markets, to reflect the value of gas for the end users.
Thank you. Andrew?
Hi, Nikos. Thank you for that. Hey, I'm just going to answer one of the questions that from an anonymous attendee who said, can I just confirm that he sees 7 US LNG cargo cancellations through May this year? I was very careful to say that Platts in their table shows 7. This is not my view. I'm requoting a public source. I'm not allowed to give a view on how many cargoes we may have seen cancelled or not. Pricing, what did we learn? I think this comes back to the flexibility. We saw some classic commodity price spikes where price went very high very quickly. And the economists will tell you that that happens when you kind of reach the outer limits of the market's ability to kind of balance supply and demand, and strange things start to happen on the way up and on the way down. Just as we saw with WTI, when folks were thinking they were running out of places to put it, my son was asking me, hey, why don't we rent a swimming pool somewhere there and put some oil in it? This is what we saw in LNG with that JKM price spike. Was the system, which is about long distance supply of cargoes, start to struggle at its limit, which was the prompt. If you turn around and say, hey, I need a cargo tomorrow, it's very hard to get that cargo from the US to the market in that time frame. So we saw a classic price spike based on what was happening in the power markets in Japan, what was happening with the weather. Some of the buyers may have got themselves classically backed into a corner by the market, and the market is very unforgiving when you do that and you need product quickly. In both of those spikes on the table, it came down very quickly as well. Once that prompt rolled over, that price came down. If that was an underlying fundamental issue, long-term issue, that wouldn't have happened. This is about prompt issues. And with any system, you can kind of stress it to its limit where you kind of use up all the flexibility, the ability of the system to react. And that's what I think we were seeing with those classic price spikes. But I think what I draw is the fact that the market's rebalanced. You know, Henry Hub seems to do that really quickly these days on the back of anything that's thrown at it. The fact that LNG was able to do it shows that really this was about an outer edge, you know, of the liquidity issue. Those prices were not, people forget when they look at those prices, those are for individual 1 or 2 cargoes on the day. This is not how much everyone is paying for LNG. The other thing I would take away as a US seller is, you know, sometimes it depends what you want from your pricing. Some folks like to play the commodity element and run with the volatility. Others want some more stability, and that's where long-term contracts, long-term pricing, be it oil, be it Henry Hub, puts that element into a buyer's portfolio.
Let me pick up on that and do one more round on the question of flexibility. Because as you said, we sort of stressed the system and we saw parts of the system that adjusted really well. Russian pipeline gas reacted very quickly. US LNG reacted. Storage in both Europe as well as the US, as Jean-Baptiste said, those were critical elements that sort of were able to flex up and down to make the system balance. And we saw the parts of the system that didn't do very well, shipping, the Panama Canal. But as you rightly pointed out, Andrew, you know, when you stress the demand or the supply side to extremes, you know, a lot of systems fail, and we saw electricity systems fails and all that. Where does that leave us in terms of the security of supply flexibility agenda? I mean, we've always talked about the need for more storage in Asia. That sort of seems to remain a challenge. But you know, we talked about shipping in a way that we haven't really talked about as much before, and the really long voyages that Jean-Baptiste, you talked about, Panama Canal. So maybe would love to get some quick reactions on sort of that flexibility, security, supply lessons / agenda going forward. And again, let me start with you, Jean-Baptiste.
Thanks. Well, on the flexibility, I guess that you mentioned one of the key elements. It's an evergreen in the market, the lack of storage in Asia, and particularly in continental Asia. And China is really working on this since they had those shortages during the winter 17-18. There are plans to develop storage. I think, if I'm not mistaken, we're talking about a dozen BCM of capacity of working gas currently, which for a market, if you compare with the amount of storage relative to consumption for North America or for Europe, this is negligible. The capacity, the technical capacity in China remains limited, especially for storage sites in depleted fields. So I assume, I'm not a geologist, but I assume that China will never be able to have those same levels of coverage of working gas capacity as we have them in Europe or North America. So the component of flexibility of imports will remain. One of the problems, this is also not something new, something already seen in the previous case 17-18, when this import flexibility for China comes from pipeline, it comes at a risk, because when it's called in China, it's usually called in the neighboring countries. And especially in Turkmenistan, doesn't have a very good record of providing additional supply or even the basic supply when the call comes. So by I would say almost by default, LNG flexibility is to be called by the Chinese market. The question of shipping is also an interesting. If we look at what happened 3 years ago, we had those curtailment on the Chinese market because the LNG capacity, especially in the north of the country, was not sufficient. The following winter, 18-19, for those who remember, we had a spike in short-term shipping rates, not because of too much need of LNG, but because cargoes were patrolling along the coast of China, waiting for the cold spell, which never happened. And since then, as Andrew said, we've had 2 rather mild winters, so the market tends to forget those. And then we're there again, not with extremely cold winter as a whole, but with some cold episodes, some extreme situation, and then we're reaching the limits of the system. The question is again, comparing the averages with what is visible and quoted by the market, the spot price either for the cargoes or for the vessels, the spot vessel is not a measure of the whole of the fleet or the whole of the trade, but this is a visible index, so it shows that there's a tension. However, it doesn't provide a clear indication of how the whole system behaves. But of course, in terms of very short-term reaction, when you need supply in case of an expected increase in demand, LNG cannot provide just by the snap fingers, simply because you have lead times to deliver. So the answers range from the supply side with storage and with other sources, but also on the demand side with being able to adjust the structure of demand, having backup capacity for power generation with other sources, all of that. So I think it's security of supply is not only a question of diversifying your supply in the short term, it's also adapting the structure of your demand to cope with those extreme situations.
Thank you. Andrew?
Yeah, I think Jean-Baptiste is right. I think we have on the one hand, we're saying we have an LNG system that is much more flexible. And the thing I find astounding is that the LNG producers in the US, not only did they turn down to such a high level, 1/3, they sprung back relatively quickly over the period of kind of Q3 and into Q4. Feed gas into US LNG increased by 8.5 BCF a day. I mean, 8.5 BCF a day is the consumption of a good-sized country. So to have that flexibility, I think, in the system is kind of something new, something unprecedented. We talked about the kind of prompt and the responsiveness being an issue. I think LNG, is much more responsive than it's ever been, but you have to, if you're in the business, you have to recognize the limits. And I suspect markets will have gone through this experience and will have learned from it, will be thinking about how they manage some of the limits in future. Just one of the examples, you talked about the Panama Canal being a constraint, and of course we saw congestion, quite high levels of congestion towards the end of last year, not just driven by LNG, but we had some atypical trade patterns happening. I would suspect that the Panama Canal had some working safety, as everyone did that's working complexes, had safety constraints in place to kind of deal with working during COVID. But we did see a constrained Panama Canal. But interestingly, when we look at the data for transit times from the US to Asia, through the second half of 2020, they were about 33 days one-way steaming time. In Q1, through Q4 and into Q1, they were 33 days. They actually didn't change that much, even though we had quite long waiting times at the canal, because obviously ships speed up and try to kind of counterbalance that. So actually the impact, probably slightly less than you would imagine. I suspect buyers would like to have kind of reduced that to a kind of a 27-day if they could have, to speed it up. And this is about the learning. Everyone will learn from that. Everyone will think about how to manage that if it happens in future. So I suspect governments, companies, buyers will all be taking on board the experience of this winter, the unprecedented experience, and thinking about how they manage that in future. Storage is a key. I mean, Jean-Baptiste's map in the background, you think about gas supply as being very flexible into Europe. It actually takes about 10 days to get from Russia, just above his kind of the right-hand side of his head, to the market. It's managed through storage in the marketplace. That 10-day lead time means it's very hard to manage kind of quite prompt, day-to-day changes. Storage in Asia will be a question, and how you manage that within that system will be a question for Asia as we go forward. I've no doubt they will build as much as they can in China.
Thank you. We have about 8 minutes to go, and I wanted to turn to a couple of regional stories. I'll begin with one, and if we have time, we'll do another. And I wanted to turn to a question that my former colleague, Gautam Sudhakar, asked on India. And obviously, India, we're seeing sort of the COVID situation become worse in the country. Always a unknown in terms of the gas market, sometimes surprising on the downside, sometimes surprising on the upside. Maybe Jean-Baptiste, you can tell us a little bit about what you're forecasting for India, sort of looking into 2021 or even a little bit beyond that, and then I'll ask Andrew to do the same.
Sure. Well, as you know, government of India has very strong ambitions into developing the share of gas in the domestic energy mix. What we have seen last year is a very fluctuant evolution of gas consumption, gas import in India. The first month were really buoyant, especially during this window opportunity when some other buyers were taking less, and India benefited from the opportunity before going itself into lockdown. And I remember the first month of March that gas even displaced some coal in power generation, which is something usually you don't see in India. At the end of the year, with the prices increasing, so that the LNG imports into India and to other neighboring markets began to falter. So for this year, we do expect that the growth in India will have some growth to offset the limited performances of last year, but most of it will come from the industrial sector, and to some extent also for the continuous rollout of the distribution network. So not much to expect from the power generation. That was clearly a one-off, owing to the very specific price conditions, I guess.
Andrew?
I'm an optimist on India. I think over time it certainly has in its mind the necessary policies, the push to develop infrastructure to grow that market for gas and particularly for LNG. I think the caveat is that it's obviously quite a price-sensitive market. So we do see it kind of come into and move out of the kind of spotlight, as it were, based on price. It's interesting that as the world was starting to turn down last year, demand was turning down and prices were getting quite low. We saw India, one of the few places, actually step up and take more volume. So I think as long as gas remains, LNG remains affordable, and that's certainly, I think, something I think we will see as we go forward in this supply abundant marketplace over time, then I think India will meet and perhaps even surpass expectations. I have a sneaking suspicion.
Thank you. Actually, I just saw a question come in, so I'm going to tweak my plans. There was a question about US LNG and hurricanes. And so we saw production being disrupted last year as well. So maybe, Andrew, can you just maybe walk us through like how important of a risk this is, how Cheniere and others have sort of managed to work through that? Then Jean-Baptiste, if you wanted to add something, that would be great too. But Andrew?
Yeah, we had a pretty major hurricane come through last year, and it had an impact, different degrees on different projects. One of the key impacts, I think, was actually not on the projects themselves, but the infrastructure. So some of the other projects took longer to come back on simply because of the power supply issues. But overall, I would say these tend to be, by definition, kind of short, sharp events. I think there's enough flexibility in the system that we can make up for cargoes. Now, we have to work quite hard to rejig the schedule, and what we did during that event was move some of our buyers across to Corpus, which was kind of not in the hurricane alley, as it were. And overall, we've had a very good track record of not missing supplies, even though we've had to reschedule, even though we've had to catch up in some cases. So actually, very few cargoes have been missed due to hurricanes. So it's clearly an impact on the system. I think it's probably less impactful than people might have in mind, given the scale of the hurricanes that we've seen. I mean, look at the scale we've seen. Look at the impacts in terms of the cargoes and the effects in terms of supplies.
Jean-Baptiste, did you want to add something on hurricanes? No, not much to say. I think that Andrew really summarized the situation. That the impact is really short-term impact. Of course, as the share of US LNG will continue to increase in the future, the volumes at stake may be bigger, but we're talking about very local and short-term impacts. As a parallel, this is something that's been affecting the U.S. oil industry for a long time in the Gulf of Mexico, and the supplies of oil have not been significantly affected by hurricanes.
So we have about a minute left, and I had a question that is way too ambitious for 1 minute. So I'm going to ask it, and if you can give your 20-second answer. Europe, we saw Qatar, US, Russia, LNG kind of like reach similar volumes. We saw intense competition between LNG and pipeline gas. Did we learn something in 2020 about the interplay and the sort of competition for the European market? I realize that this requires a 2-hour-long answer, but if you have a quick remark, I would really love to hear it. Jean-Baptiste?
Well, to make it very quick, it's all about flexibility. There's a share of volumes which is under contract, whether it's pipeline or LNG, but with flexibility clauses, flexibility volumes that enable either to divert, not to take, or to carry forward. Of course, it will take a bit of time to readjust, especially for the volumes carried forward, but this is an illustration. First, Europe is the balancing market, and second, that we've been through a lot of changes over the past decade to achieve such a level of flexibility.
And the final word, Andrew.
Competition is good. Flexibility is good. Back to the 3: affordable, reliable, sustainable. We don't really, a lot has been made about competition between, say, the US versus Russia. We don't see it as competition against any particular supplier. We see it about being competitive, Cheniere being competitive into the marketplace. giving our customers what we want. And as long as the industry is competitive, we think LNG will be a fuel that they will want to buy, and that will be good for us and for everyone.
Well, thank you for that, and thank you both, Jean-Baptiste, for giving this presentation, and thank you also to your colleagues for putting this together. I am very appreciative of the efforts that the International Energy Agency is making to increase the transparency and improve sort of the level of data and education in this market. So please pass on my thanks to the rest of the team. And Andrew, thank you so much for joining us and for offering your thoughts. Always great to talk about natural gas issues with you. And thank you everyone for tuning in. Really appreciate you joining us. Have a good rest of your day.